Such an honor to be with you all here today. It's an incredible audience, and it's wonderful to be here. My name's Chris Nelson. This is From Commons to Claims. I'm COO at Shrax. We are a publicly traded company, and so my expertise as an operator is operating in the public space. There we go. Some things I may say during this presentation about Shrax and our subsidiary, Big Token, may not come true in the future, and if that occurs, I'm truly sorry. Things tend to change. Shrax is a publicly traded company on NASDAQ. We build advertising technology and data technology. We've been operating for over 8 years in multiple countries. Annual revenues around $40 million and 120 people. Big Token is a platform that allows consumers to own, verify, and sell their data. It's also an open ecosystem that allows third-party applications to build on top of that graph. I am not a lawyer, and so this is not legal advice. I'm also not a financial advisor, so don't make investments based on this. I am an American, and as a result, this is entirely about America. We can't help it. That said, I do think what's happening in the United States around crypto and blockchain paints an interesting regulatory picture about what's happening globally, and also we can learn valuable lessons from that progress. So what we'll do, we'll talk about certain economic conditions, historically speaking. We'll talk about what's going on now and what that looks like for the future. I'm from California, and California was founded based on the gold rush, our first big economic boom. Gold rush, interestingly, began as a discovery that was entirely accidental. People were doing other stuff, and the gold rush happened with the founding of gold built out of a meal. And so people were under construction on a power mill, and that resulted in the discovery of gold. People were very, very skeptical early on. No one believed it. Papers were reporting on it. No one really was enthusiastic for about 6 months, until a gentleman walked down the streets of San Francisco with gold waving it above his head. People then left what they were doing in San Francisco, a very small community, and went out and began looking for gold. This started the gold rush. At this time, the population of California was 14,000 people. And over the next few years, it boomed to 250,000 people. It was a small community of people that trusted each other, of people that worked together and believed everyone was going to get rich. Kind of sounds like early crypto, right? But with that population explosion came a lot of bad actors, came a lot of people seeking to do harm. And so what we see early on in conditions of economic explosion is that some people in those conditions will seek wrong actions. And in the right conditions, lots of people will seek good actions. Conditions foster behavior. And so in the gold rush, we have an accidental discovery, small collaborative community, a big expansion of value, a big expansion of population, operated initially non-geographical. California wasn't yet a territory or a state, operated non-governmentally, and ultimately ended with governance and regulation. Big explosions of value often create governance and regulation because markets need that to expand. Bitcoin and blockchain crypto technology follows that same similar path, right? You have a discovery, small collaborative community, big expansion of value, big expansion of population, operates non-geographically, operates non-governmentally, unintended consequences ensue, bad stuff happens, right? Ultimately, then, government steps in. And we can see this by the explosion in the ICO market, right? This was done in late December. Numbers for December haven't come in yet. As you guys know, those numbers were huge as well. Right? Alan Greenspan, in the middle of the 90s, said, how do we know when irrational exuberance has unduly escalated the asset values? Right? He was talking about Internet 1 bubble. Right? Very, very similar crypto bubble to the Internet 1 bubble. And we'll talk about that in a little bit of in a couple seconds. So some bubbles, what we can see by looking at the history of bubbles, some bubbles can lead to lots of value and little regulation. Some bubbles lead to no value and lots of regulation. What's our opportunity in crypto? If you look at the dot-com bubble, right, which began with the explosion of the Netscape stock in 1995 and ran all the way up to the middle of 2000, we see a lot of value created, infrastructure, knowledge, companies that exist today. 50% of our top 10 most valuable companies in the world were founded or grew substantially during this period. We got PayPal, we got eBay, we got Amazon, we got Google, Netflix, AOL, Alibaba, Yahoo, and the Wikipedia project was started. Right? Incredible value was created during that time. A lot of money was lost too. A lot of money was lost. But with that came a whole new economy. Now, in contrast, we have the housing bubble, right? And to not go into too much detail, lots of people were given loans that couldn't afford them. Right? Those loans were packaged together and sold as securities. People bet against those securities and ultimately won because people couldn't pay for those loans. Right? We have another bubble here. Lots of money was spent, lots of money was lost. And what resulted in almost no value. Lots of empty homes, and then lots of regulation followed. So we look at these two bubbles in contrast, and people wonder nowadays, are we in a bubble? Is crypto a bubble? Is Bitcoin a bubble? That's basically every news channel, every day for the last 6 months. A little bit less now since the price is down, but when it starts going back up, we'll be back on track on that. And if you go back a year from now, the gains in Bitcoin and other cryptos is still quite incredible. And so, yes, it's very clear we're in a bubble. Right? But what do we do with that bubble, and what comes out of it is ultimately up to us. This bubble was driven primarily by one thing. If you look from the outside and you're an outsider, the bubble's Bitcoin, right? But if you're on the inside and you're an insider, the bubble is in the altcoins, right? The utility tokens, what was said earlier, the shitcoins, right? That's where the bubble's at. And that was really built and based on, in the United States, failing the Howey test. Almost every utility token has some answer to how to deal with the United States. And that's, you fail the Howey test, you operate in the United States, you don't operate in the United States, you bar US citizens, or you follow some path in the United States. But that was really based on that Howey test and failing the Howey test, right? And then a bunch of other stuff after that. And so a lot of people relied on this as a method to organize capital and really skirt around US securities laws. And that's created some market conditions that are pretty challenging. The SEC has a 3-point mission. That's to protect investors, maintain fair markets, right, and facilitate capital organization. It's three parts, and they're constantly balancing these three things. And we're already seeing enforcement pretty early on, actually, right? Enforcement against specific ICOs, assets frozen, ICOs halted. We're seeing civil action. We're seeing enforcement against public companies in the crypto space or public companies pretending to enter the crypto space. All because of something that happened almost 100 years ago. And that's the market crash of 1929. What led up to this was manipulation of markets, insider trading, inconsistent disclosures, outright fraud, paid media pump and dump schemes, access by unsophisticated, undercapitalized investors, promotion from bad actors. Basically sounds like a roadmap for an ICO. Thank you. Let's go back. And so we end up here, right? Middle of December, height of the exuberance, Bitcoin's approaching 20,000. Everyone you know is now a Bitcoin expert, right? Your bartender, your taxi driver. I'm at CES at the beginning of January. My taxi driver on the way from the airport to my hotel is telling me what coins I should buy and what coins I should not buy. He's also offering to sell me other things. It's Las Vegas. And so we're in a state now where people are doing things that led to the market crash of 1929. SEC is going to start taking notice, right? Same thing happened 1928. Irrational exuberance. And that led to this, which created the SEC and ultimately created the first set of security laws in the United States. Remember, the SEC has that three-pronged mission. But first and foremost, they want to protect investors. And so, over the last 6 months, they've released a series of statements which culminated in the December 11th statement. They made a couple important points here. Number one, investors should be careful. Number two, merely calling something a utility token does not mean it's not a security. Number three, the gatekeepers, the lawyers, the accountants, right? Everyone involved in helping people launch these products should be very, very careful. And this was reiterated in their February 5th statements. They said the gatekeepers have not done a good job in helping us regulate this market. Brokering securities requires licenses. You have to be able to demonstrate that your token is not a security. The onus is not to demonstrate how it's utility. The onus is to demonstrate how it's not a security. And then ultimately, the SEC will enforce and will police. On the other hand, they're responsible for the expansion of progress, the expansion of capital, right? And they're believers in the opportunity that blockchain and crypto has for our markets. And there's very clear methods to do this in the United States that aren't easy, but they're clear. One thing that I hear so often in the crypto and ICO space is that, like, we just don't know. The SEC won't tell us. They won't give us clear guidance, which is baffling to me. It's like we have almost 100 years of securities laws. Like, that's pretty clear, right? Just because you don't like them does not mean it's not clear. And securities laws, by the way, are easier now than they've been in the last 80 years. In the United States, in 2012, we had the Jobs Act, which created a whole group of exemptions for lower capitalized companies to raise capitals without going through the registration process that securities require. On top of that, we also have the registrations. There are methods to do this. And securities don't just have to mean equity. Securities don't just have to mean voting rights. They can, but they can also have rights to revenue, they can have rights to profit, or a combination of those things. So what we're doing with Big Token is a unique crypto, a unique token. And I look forward to talking to you guys more about that one-on-one. We are going through a process now, so I can't go into too much detail about what we're doing yet. But some exciting things to come. And so environment can foster certain conditions. The wrong conditions can create bad actors. The right conditions can lead to most people doing good things. The gold rush, after California became a state, and that happened in 1850, gold production doubled in 1 year and maintained that, right? So you go from common land and common law to regulated environments, right? With that, you see the value double in 1 year. Markets need regulation. The right conditions can accelerate opportunities. Blockchain and crypto, I believe, has created the most efficient method of organizing capital in human history. Right? With the right regulation, in the right environment, we can create an incredible economic and technological expansion, greater than we saw in the 90s. So let's create. Right? Web 1.0 allowed us to connect. Web 2.0 allowed us to socialize. Web 3.0 is our opportunity to decentralize. Right now, we're in token 1. And that's confusion, chaos, right? We're in the common land of token. Let's move that to token 2.0. That's order regulation, right? And with token 2.0, let's create Web 3. Thank you all very much.